Welcome to the UK mortgage market briefing for the week ending the 30th of January 2026. If you're a regular here, welcome back. And if you're new here, thanks for finding the channel. As always, these are just calm, practical updates on what's actually happening in the mortgage market. No drama, no predictions. A quick request from me, if that's okay. If you find these videos useful, just do please give them a like and consider subscribing to the channel. It genuinely helps, and it means that you'll see these each Friday without having to go hunting for them. So this week we'll look at what's happened with mortgage rates, what swap rates have been doing, and there's some really interesting lender behaviour, particularly around how much lenders are prepared to lend. And then towards the end of the video, I'll pull it all together with key takeaways and who this market actually matters for right now. So make sure you keep watching. And just to say, I want this channel to be shaped by you, so please make sure you comment below. I do read them, and I do use them to shape future videos. So if there's something that you want covered, please do let me know and I'll do my best. So stepping back, first, this week hasn't been about big headline moves. Rates haven't suddenly fallen away and they also haven't spiked. What we've had instead is a fairly quiet pricing week, but a very telling week in terms of lender intent. So while the noise might suggest nothing much has really happened, the reality is there's been quite a lot going on beneath the surface, especially around affordability and who lenders are actually looking to try and support. Starting with mortgage rates, this week it's been a bit of a mix. We've seen some small increases. Virgin, for example, have nudged a few rates up, which follows on from last week's broader improvements across the market. On the flip side, in the slightly adverse credit space, LendInvest have made some meaningful cuts. In some cases, we're talking up to 35 basis points, which is a decent move and worth noting if you sit in that category. We've also seen Barclays make some notable changes, particularly for people buying at higher loan-to-value levels. Now that's important because that's where affordability pressure is still most acute. Now just to be clear, this video is always a headline overview. All the individual rate changes from lenders go up on my Instagram stories as they happen. So if you want day-to-day detail, please go and follow me over there. There should be my profile on the screen. Now looking at swap rates, we've had a very slight uptick this week. Nothing too dramatic, but enough to explain why lenders haven't been rushing out with sweeping price cuts. And this is the key point, because pricing has been relatively quiet. It strongly suggests that the changes we have seen are about market positioning, not all-out competition. Lenders aren't panicking, they're choosing. Moving on to lender behaviour and criteria, and this is where this week really stands out. So first up, Bank of Ireland. They've made some changes in their bespoke mortgage range, offering up to 6 times income, aimed at higher earners. On top of that, they've improved their maximum borrowing limits. Up to 1.25 million purchase price, you can borrow up to 90%. Up to 2 million, it's 85%, and up to 2.5 million, it's 80%. That's a very deliberate move, and it tells you exactly who they're trying to attract. NatWest have also made an important change. They've improved their residential loan-to-income calculations. So for sole incomes of 75,000 or joint incomes of 100,000, affordability moves from 5.5 times to 6 times income. And for incomes of 40,000 plus, it increases from 5 times to 5.5 times. These changes apply to repayment mortgages only, but they still make a real difference. In the adverse space, Mansfield Building Society have improved criteria on their credit repair range up to 70% loan to value. They will now allow up to 5 missed payments in the last 12 months, provided accounts are up to date now, of course, on things like credit cards, utilities, mobiles, and mail order. And finally, Melton Building Society have launched a new 100% mortgage for first-time buyers. From the 2nd of February, it's available to first-time buyers purchasing in the East Midlands. It's a 5-year fixed rate at 5.99%, and it has a low £199 arrangement fee, but you get that back on completion. They're also considering a wider geographic rollout later in the year. So when you step back and look at all of this together, the message from lenders is actually pretty clear. They're actively trying to help more people get on and move up the property ladder. And just to round that off, don't forget there are schemes like the Nationwide Helping Hand offering up to 6 times income, and newer lenders like April and Perenna offering much longer term fixed rates, and in some cases up to 7 times income. But remember, and this is important, just because you can borrow more, it doesn't mean that you should. This is where advice really matters. So what does all of this mean in practice? Well, if you're a buyer, particularly a first-time buyer, affordability is quietly improving. Not necessarily through headline rate cuts, but through how lenders assess you. If you're a home mover, there's more flexibility creeping back in than there was this time last year. And if you're just watching rates from week to week, it's important not to overreact. This isn't a market that's swinging wildly, it's just one that's slowly repositioning itself. Now, just to flag this, at the time of recording, we are still waiting on some key macro data, so I'll insert that into the video when it's released. Okay, so we've now also had the latest Bank of England money and lending data for December 2025. The headline here is that households and businesses are still being fairly cautious. Mortgage borrowing itself was basically unchanged in December, which tells us that the housing market isn't accelerating, but it also isn't falling away. What has changed is mortgage approvals. Approvals for house purchases dipped slightly, while remortgaging approvals rose. And that fits with what I'm seeing. People are focusing on refinancing, planning ahead, and managing costs, rather than stretching. What's striking about this data is the timing. This covers the festive period, which is usually quieter anyway, and it also comes after a period of uncertainty following the late autumn budget, where a lot of people, quite understandably, paused decisions. So when you look at it through that lens, the numbers actually suggest there's pent-up demand sitting in the background rather than a lack of interest. On the consumer side, borrowing on things like credit cards and personal loans slowed again in December, which tells us that households are being more careful with spending, but they're not disengaging entirely. We've also seen the average rate on newly taken mortgages tick down slightly, while savings rates are edging lower. That combination is important. So when you step back, this December 25 data sets the scene for a busier 26, driven by improving affordability and decisions that were delayed rather than cancelled. From a mortgage point of view, that supports what we're seeing: steady pricing, selective lender support, and gradual improvements, rather than anything sudden or too dramatic. Okay, we're back in the main video. So one thing you'll probably hear a lot about this coming week is the Bank of England meeting, with the base rate decision being announced next Thursday. It's the first meeting of 2026 following the rate cut back in December, and the backdrop is a little bit mixed. Inflation's picked up recently, as we know, but the economy's clearly slowing and the jobs data hasn't been great. So there's a lot of noise around what the MPC might actually do. The key thing to remember is that mortgage pricing tends to move on expectations and swap rates, not the actual announcement itself. So it's worth being aware of it, but just not overreacting to the headlines. But let me know what you think they will or should do next Thursday. Drop it in the comments. So pulling this all together, the key takeaways this week. First, rate movement has been limited, but lender behaviour has been meaningful. And second, affordability is improving more through criteria than pricing itself. Thirdly, just remember, preparation matters more than ever. Now, I've done quite a bit of live content this week, and I've seen people saying that they're offering on properties, even entering bidding wars, without having their affordability checked. And that's where people get caught out. Because right now, this market is most relevant for first-time buyers in particular, with home movers close behind. If you're sitting on a long fixed rate with years left to run, there's probably no need for you to react at all. But if you're buying, moving, or planning a change this year, preparation is key. As always, these updates are here every Friday, so if you want to stay on top of the market without the noise, please make sure that you're subscribed. And just a reminder, mortgage decisions should always be based on advice tailored to your own situation. As I mentioned at the beginning of the video, if there's something that you'd like me to cover in future updates, please do drop it in the comments, because it will help to shape the channel, especially in quieter news weeks, and I do try to reply to everybody. But for now, thanks for watching. Don't forget to subscribe, and I'll see you next week. Take care.